So, welcome to 2023. Finally, seems like 2022 is one of those years many would like to forget. But before we put it completely in the rearview mirror, what are some of the lessons that we can take forward to help us in 2023 and beyond? There's no lack of global and economic news stories in 2022, starting with the war in Ukraine, more COVID-19 lockdowns in China, the midterm elections in the United States. We saw a lot of newsworthy events, some predictable, quite a few maybe less than predictable. Possibly, though, the most important economic news of 2022 was the combination of stubborn inflation and the central banks, including the Federal Reserve, raising rates to try and drive it back down. Calendar years with negative stock market returns are not out of the ordinary. In those years, historically, though, bonds have been good diversifiers. But in 2022, due to the Fed's rate raising in response to inflation, bond markets had by many measures their worst year on record. Some would say maybe going back as far as the late 1700s. We'll talk about that in a minute. Many stock markets, however, were down over 20% for the year before we got a reprieve finally in the fourth quarter. October and December gave credence to the saying, you must be present to win, because during the fourth quarter, markets rewarded investors who stayed diversified and stayed invested, as many previously below average markets became leaders. This was particularly true for foreign developed markets and stock markets, as well as value stocks as well. After 5 years of leading global markets, one of the negative spots was U.S. large growth stocks, and especially the tech-heavy NASDAQ. That market saw the largest decline for the year, and this continued through December. So what else happened in 2022? Well, we're going to look a little more closely at some pictures of 2022 economically and financially just to see where we've been. And to help us, I've asked Foster Group's Director of Investment, Michael Westphal, to walk through some of the charts that he found most telling in 2022 to see what we can learn. So, Michael, welcome. Glad to have you here.
Thanks, Ken.
I think our first chart has to do with the Russian stock market and the war in Ukraine.
Yes, on February 24th of 2022, Russia invaded Ukraine. While it doesn't compare to the devastation and lost life in Ukraine, it was notable for investors that the value of Russia's stock market was written down to zero. Russia's stock market was deemed uninvestable by the investment community. Fortunately, this was a very small part of a globally diversified investor's portfolio, generally less than 0.5% overall.
Yeah, it's quite a way to kick off the year in terms of how things were going. Now, one of the things that happened as that invasion began is we saw oil prices, natural gas prices, certain kind of agricultural products, their prices really began to inflate along with the inflation we'd already been seeing in 2021. As a matter of fact, at the end of 2021, inflation as measured by CPI was already running at over 7%. With the Fed's target rate of inflation between 2 and 3%, now it's time for them to think about taking some action. But let's take a look at the history of inflation. Tell us how we got here.
Yeah, so first thing I'll note is that inflation really impacted the entire globe. We saw UK's inflation go over 10%, Europe's inflation was over 8%, and there were many reasons for this. We saw, as you mentioned, a big impact from the war in Ukraine with agricultural and commodities, oil and natural gas most notably. We saw the end of some COVID-era stimulus really impacting, and there has been a supply shortage, particularly in semiconductors, that has impacted the globe. The U.S. hit a 40-year high, peaking at 9.1% for the trailing 12 months in CPI, ending June of 2022.
Yeah, that peak was something else. We've seen it come off a little bit here at the end of the year, but there's no certainty that we're done having to fight inflation yet. The Fed's top two goals, they say, are stable prices, which they define as keeping inflation at around 2 to 3%, and then full or healthy employment. Now, unemployment numbers stayed historically low in 2022, but the Fed did take historic actions in 2022 to fight inflation. Here's a picture of that. Tell us what we're looking at here.
Yeah, the Fed's top goal currently is certainly to fight inflation, and rate increases are the primary tool that they have in their arsenal to do that. On March 16th, the Fed began raising interest rates after cutting them to zero back in 2020. All in, the Fed increased rates 7 times in 2022, with 4 of those increases being 75 basis points. You can see that on the far right-hand side of the chart as the rate just shot almost straight up. We actually got to the highest Fed funds rate since before the great financial crisis back in 2007.
Yeah, so that picture on the right, it just looks like a straight stair step going up as the Fed tries to get its hands around inflation. Now, they set one rate, but their actions with that one rate has impacts on other rates in the economy as well. Here's one.
Yeah, due in part to the Fed increasing rates, mortgage rates really surged in 2022. We saw the 30-year mortgage rate go above 6% for the first time since 2008. And we saw it go above 7% in the fourth quarter. That's notable because it really increases the cost of borrowing. If you have a mortgage rate at 3% and take that rate up to 6.5%, a $400,000 house, that monthly payment goes up almost $850.
Wow. Yeah. So the linkage here, just again, kind of the linkage between raising rates and what the Fed's trying to do in terms of inflation is as they raise rates, they increase the cost of borrowing. The idea there is, and people will spend less because goods and services seem to cost more. So that's kind of the logic behind it. It seems like it was beginning to take effect at the end of the year. We'll see how we do here in 2023. So we talked a little bit about, and I hinted at this at the beginning of today's session, that the bond market may have had its worst year since the 1780s. So that's amazing to think about. I was reading what you had written regarding the bond market. So tell us what you mean by that.
Yeah, so the Wall Street Journal noted that the 10-year U.S. Treasury note had its worst performance in 234 years. That would have made the year 1788, and I had to look it up, but that was 1 year before Treasury Secretary Alexander Hamilton actually took office. Now, data going back that far is a bit suspect, but it's certainly the largest loss that I could find with data that is a little bit more trustworthy going back to 1928.
Wow, that's just an amazing number in itself, to think that almost as long as we've had kind of a U.S. financial market, at least a U.S. federal lending market, this is the worst bond market for the 10-year that we've ever seen. And that just talks about how fast and how significant the Fed took action to try and get inflation under control. We'll see. Hopefully what we've seen is that peak that we saw in June, and inflation will begin to decline, so the Fed doesn't have to take quite as significant of action going forward. But that idea that we have to go back to Hamilton time to find something worse just tells us what kind of a year we were in. So, Michael, as an investor, when you think about 2022, what do you take away from a year like this one that helps you kind of put it in context, but also think about 2023?
Yeah, so probably the biggest takeaway for me is that it's the risks that are not on your radar that are the most impactful. One really easy example of that is going back in the beginning of 2020, no one had a global pandemic on their risk screen. This year, we really didn't think that Russia was going to invade Ukraine. That was not on our risk profile at the beginning of last year. Similarly, while we thought that the Fed was probably going to raise rates, as you mentioned, inflation was at 7%. They were using the words transitory to describe inflation back then. They thought it was going to be over as the supply chain shortages resolved themselves. Well, that didn't happen. And we saw from that chart that the Fed funds rate just skyrocketed, which no one really expected the Fed to raise rates that far, that quickly, including the Fed members themselves.
Yeah, I thought that was interesting how they had to kind of, and many of them did admit that throughout the year, going, we just didn't see this happening. And of course, what happened right at the beginning of the year in Ukraine just added fuel to that fire in terms of how the inflationary experience affected people really around the world. I think one lesson, and you mentioned it, that we take away repeatedly is just the uncertainty from year to year in terms of what is going to happen in the world, and then what the market's response is going to be to whatever unexpected news items ultimately appear. Even the most experienced, successful investors of all time, they understand just how unpredictable markets are. As always, 2023, there's going to be a lot of negative news stories. Some of those stories, unfortunately, will come to pass. But for investors, most of them are going to turn out to be short-term noise, which only tempts us to act in unproductive and even harmful ways. Think about that, Michael. When you and I have had some conversations recently around the way markets are positioned going forward, what might give you some optimism for how things might turn out in 2023 or kind of going forward from here?
Yeah. So as you mentioned at the beginning, we had a strong fourth quarter. So, that was some very welcome news, but I'm very optimistic right now, particularly for something like the 60-40 equity fixed income portfolio right now. You're getting decent valuations finally on the equity markets after they came down last year, and you're finally getting paid on the fixed income portion of your portfolio with rates 4% or higher, where you were getting almost nothing in the past several years.
Yeah, I think 2022, as we've talked about it, it's a little bit of a transition year for fixed income. We're going from that 0 kind of percent rate environment where investors in fixed income really weren't getting paid much in terms of interest rates. Then the rates had to raise as the Fed was fighting inflation. But the good news there is for investors who are choosing to buy fixed income, even money markets today are yielding over 4%. So the idea that you are now at least having a positive expected rate of return for holding fixed income allows you to be a little bit more optimistic in terms of the long-term picture for that 60-40 portfolio or just a diversified portfolio in general. I would say, and we think this, that investors who stay diversified and stay invested according to a solid financial plan, the one that best reflects what matters most to them, they just have the best chance of continuing to do well. So, interesting year 2022. We're looking forward to 2023. We're looking forward to traveling this path along with you. I'm sure there's going to be some interesting news along the way. We'll try to bring that to you as we do every couple of weeks here on Financial Perspectives. Hope that you'll tune in and join us. And Michael, thanks for joining us today in our first episode of the year.
Thank you.